You've seen it 100 times. Someone on your phone, younger than you, talking fast about buying the dip, about Tesla, about a stock that ran 40%. And somewhere in the back of your mind, a quiet, slightly embarrassing question forms. One you'd never say out loud at this age. What is a stock, actually? What are these people even buying? Here's the part nobody tells you. The reason that question feels embarrassing is by design. An entire industry makes money keeping you feeling like the answer is too complicated for you, like the door has a velvet rope and your name isn't on the list. So you nod along, you change the channel, and you let your money sit somewhere safe, quietly losing ground for another year. I'm going to take that whole wall down in the next few minutes. Not with jargon, with one simple idea that once you see it, you can never unsee. And it will change the way you look at every headline, every app, every nervous red number for the rest of your life. Let me show you the blueprint. Let's start with the single sentence that everything else hangs from. A stock is a piece of ownership in a company. That's it. When you buy a share, you don't own a lottery ticket. You don't own a number on a screen. You own a small, real, legal slice of an actual business. Its buildings, its brand, its inventory, its profits, its future. If that company has 1,000 employees showing up to work tomorrow morning, you own a sliver of what they're building. Picture a bakery on a corner, a good one. The ovens, the recipes handed down and tested over years, the line out the door on Saturday morning, the name painted on the window. Now imagine that entire bakery, everything it is and everything it earns, divided into 1,000 equal slices. Each slice is what we call a share. When you buy one, you're not buying bread. You're buying a 1,000th piece of the whole operation. The ovens are partly yours. The Saturday line is partly yours. The recipes are partly yours. And if the bakery does well, your slice is worth more. Not because of magic, but because the thing you own a piece of became more valuable. This is where most people get it wrong. They think investing is about guessing which way a price will jump this week. They picture a casino, a screen full of flashing numbers, a game rigged for people smarter and faster than them. But it isn't a casino. Underneath every ticker symbol is a real company, with real employees making a real product that real customers pay for. The price on your screen is just what other people are willing to pay today for one slice of it. The business and the price are two different things, and we'll come back to that because the gap between them is exactly where the fear lives and where the opportunity hides. Let me put a number on it so it stops being abstract. Suppose that corner bakery is worth $100,000 and it's divided into 1,000 shares. Each share represents $100 of the business. Buy 10 shares for $1,000 and you genuinely own 1% of that bakery, 1% of every loaf, every holiday rush, every dollar of profit it ever makes. You're not betting on the bakery. You're a part owner of it. That is a completely different relationship, and it changes everything about how you behave when times get hard. Now, real companies aren't divided into 1,000 slices. They're divided into millions, sometimes billions. So the slice you'd own of a giant company is tiny, a sliver of a sliver. But here is the thing that matters, the thing that should make you sit up a little straighter. A tiny piece of a great business, held for a long time, is one of the most powerful wealth-building tools ordinary people have ever been given. Not the rich, not the insiders, you. The same slice, at the same price, available from the same phone in your hand as the one a hedge fund manager is holding in Manhattan. For most of human history, owning a piece of a great enterprise was reserved for the wealthy and the well-connected. The people who already had power got to own the things that produced more of it. Today, A retired school teacher in Ohio and a billionaire in New York buy their slice of the very same company on the very same exchange at the very same price. The teacher doesn't get a worse deal for being a teacher. That is not a small thing. That is one of the quietest, most democratic financial revolutions ever to happen. And almost nobody talks about it that way because there's no profit in making you feel powerful. There's far more profit in making you feel like you need an expert. So hold on to the bakery. A share is a slice. You're an owner, not a gambler. Everything else we cover today, exchanges, dividends, the different kinds of shares, the risk, is just detail hanging off that one true sentence. Here's a fair question, and most explanations skip right past it. Why would a company sell pieces of itself to strangers in the first place? Why let you in at all? If the bakery is so good, why not keep all of it? The answer is simple, and once you understand it, the whole machine starts to make sense. Building a business is expensive. Growing one is even more expensive. A company that wants to open new locations, build a factory, develop a product, or hire 100 people needs money up front, often far more than it has sitting in the bank. The money has to come from somewhere before the growth can happen. It has two basic ways to get that money, and the choice between them tells you almost everything about how finance really works. The first way is to borrow it. Go to a bank, take a loan, and pay it back over years, with interest every single month, whether business is booming or barely surviving. The debt sits on the company's shoulders like a weight. The bank doesn't share the risk, and it doesn't care how the company feels. It wants its payment on the first of the month regardless. If the business has a terrible year, the loan payment is still due. That pressure has killed a lot of good companies. The second way is to sell ownership. Instead of borrowing, the company divides itself into shares and sells some of them to investors. And here's the crucial part. The part the schoolyard version of this story always gets a little wrong. When a company first sells those new shares to raise money, in what's called its initial public offering, or in later offerings, that money goes to the company. It's theirs to keep and use, with no obligation to pay it back like a loan, and no monthly payment hanging over them. In exchange, the buyers become part owners. The company gives up a piece of itself forever, and the people who believed in it early get to share in whatever it becomes. Borrowing means you owe. Selling shares means you share. That's the trade. Let me make this real with someone you might recognize. Imagine Diane, 58, who has spent 30 years as a pastry chef in other people's kitchens and finally wants to open her own bakery, the corner shop we talked about. She runs the numbers honestly, the way you would. She needs $200,000 to do it right. The lease, the ovens, the renovation, 6 months of payroll before the place turns a profit. She has $100,000 saved from 3 decades of careful work. She's short by half. She has the same 2 choices every company has. She could take a bank loan for the missing $100,000 and lie awake every night for 10 years owing money. That payment due whether or not it rains on opening week. Or she could keep half the business for herself and sell the other half, divided into slices, to a few people who believe in her. She chooses to sell slices. She keeps 5 of 10 shares for herself, since she's putting in half the money, and offers the other 5 at $50,000 each. Her old friend Robert, 62, has watched Diane bake for years at weddings and holidays and has no doubt she'll succeed. He buys 1 slice for $50,000. Now Robert owns 1 share out of 10% of the bakery, for his $50,000, and the other early backers take the rest. Diane has her $200,000, no monthly loan crushing her, and partners who are genuinely rooting for her instead of a bank waiting to be paid. That, in miniature, is exactly what happens when a company goes public, just multiplied by millions of slices and millions of Dianes and Roberts. But now I have to be honest with you, because honesty is the whole point of this channel. And here's a distinction that trips up almost everyone, including people who've owned stocks for years. The day Robert handed Diane $50,000, that money went to the business. It built the ovens. But a year later, when Robert decides to sell his slice to someone else, that money goes to Robert, not to the bakery. The bakery doesn't see a single cent of it. It already got its money the day the slice was first sold. This is the difference between the primary market and the secondary market. And it sounds technical, but it's actually simple. When a company first issues shares, it's like buying a car straight from the factory. The money goes to the maker, who uses it to build more cars. After that, every time the car changes hands, it's like buying a used car from a neighbor. The money goes to the neighbor, not back to the factory. Almost every share you will ever buy on an app is a used car, bought from another investor who's ready to sell. The company already got its money long ago, on the day that share was first created. You're simply buying your slice from someone who's ready to part with theirs. If you fix this one misunderstanding, everything changes. Because now you understand that the price of a share, day to day, isn't the company doing anything at all. It's just investors trading slices among themselves, agreeing on new prices, while the real bakery goes on baking bread exactly the same as yesterday, completely indifferent to what its slice is traded for this afternoon. So you own a slice. The obvious question is the one everyone's really asking, but feels too shy to ask plainly. How does that slice actually make me money? Or lose it? Let's stay with Diane's bakery, because the math is small enough to hold in your hands and feel in your gut. Robert bought 10% of the business for $50,000, back when the whole thing was worth $200,000. Hold those numbers. Now fast forward 5 years. Diane was every bit as good as Robert believed. Word spread, the Saturday line got longer, and she opened 3 more locations across the region. The bakery that was worth $200,000 is now a small regional company worth $600,000. It tripled. Robert's slice, that same 10%, is now worth $60,000. He put in $50,000. If he sold today, he'd walk away with $60,000 for an investment that cost him $50,000, a $10,000 profit on the slice itself, plus whatever the bakery paid him along the way. He didn't need a single loaf. He simply owned a piece of something that grew, and his piece grew with it. That is the entire engine of stock investing, right there in one sentence. When the business becomes more valuable, your slice of it becomes more valuable too. You don't have to work in it. You don't have to manage it. You rise with it because you own a piece of it. But I am not going to lie to you the way the fast-talking videos do, because the lie is exactly where people get hurt. Investing is not a one-way escalator to the sky. Let's run the other version of Diane's story, the one nobody posts about. Suppose she expanded too fast, took on more rent than the new locations could carry. Then a recession hit, and people who used to buy a $12 pastry on a whim started making coffee at home instead. The business that was worth $200,000 fell to $120,000. Robert's 10% is now worth $12,000. He put in $50,000. On paper, he is down $38,000. That is real. That happens. Anyone who tells you stocks only go up is either lying to you or about to sell you something, usually both. Here's the part that separates the people who quietly build wealth from the people who get burned and swear off investing forever. Notice the two words I keep using: on paper. Robert hasn't actually lost anything until he sells. The loss is only ink until he makes it real. If he panics during the bad year and sells his slice for $12,000, he locks in that $38,000 loss forever. It becomes permanent the moment he hits sell. But if he understands what he owns, 10% of a real bakery with real ovens, a real brand, and real customers who will come back when the economy steadies, he can simply hold on and wait. Recessions end. People buy pastries again. Diane closes the one bad location and the business heals. The slice he holds is tied to something real, and real things, given time, tend to recover. This is the difference between price and value, and it is the most important idea in this entire video. So let me say it as plainly as I can. Price is what the slice trades for today, set by the moods, fears, and hopes of a crowd of strangers. Value is what the business is actually worth underneath all that noise, the ovens, the brand, the earning power. In the short term, price bounces around wildly on emotion. The crowd panics and the price drops, even though not a single oven was sold. In the long term, though, price tends to follow value home, because eventually, reality wins. The investor who understands this sleeps soundly through the bad years. The one who doesn't sells at the very bottom to a calmer investor and then calls the whole thing a rigged game. There's one more way your slice can put money in your pocket, and it's worth understanding clearly. When a company is profitable, it can choose to share a portion of those profits directly with its owners in regular payments called dividends. It's a slice of the earnings, sent to you simply for being an owner, and it can land in your account whether the share price went up or down that quarter. Picture Diane, in a good year, sending Robert a check for his share of the profits, just because he's a part owner. That's a dividend. We'll come back to dividends in a few minutes because there's a comfortable myth about them I need to clear up before it costs you money. But hold the core idea first. As an owner, you can make money two ways. The slice itself grows in value over time, and the business can pay you along the way. So where do people actually go to buy and sell these slices? They go to a stock exchange. And I want you to strip away all the drama around that word, because the drama is half of what's been intimidating you. A stock exchange is a marketplace. That's all it is. It's a place where people who own slices and people who want to buy slices find each other and agree on a price. You already understand a farmer's market. Sellers on one side with what they've got, buyers on the other deciding what they'll pay, prices settling somewhere in between. A stock exchange is that exact same ancient idea, just for pieces of companies instead of tomatoes and sweet corn. The famous ones have names you've heard on the news for decades: the New York Stock Exchange, the NASDAQ. For most of history, you needed an actual person physically standing on a crowded floor, shouting to trade for you, and ordinary people never went near it. Today, that entire marketplace fits in your pocket. The same exchange the professionals use is one tap away on an app, with no velvet rope, no special permission, and no one checking whether you belong there. You do. Now, not every slice is the same kind of slice, and here's a useful distinction that sounds fancy but isn't. When a company sells ownership, it usually comes in two main types: common stock and preferred stock. Think of them as a standard seat and a different kind of seat at the same event. Both get you in the door, but the terms and the perks are different. Common stock is what almost everyone means when they say stocks. When you own it, you usually get a vote in major company decisions. 1 share, 1 vote, 100 shares, 100 votes. So you have a tiny say in things like who sits on the board, and you get the full upside if the business grows. If the company becomes the next great success story, common shares are the ones that can multiply many times over. That's the reward, and it's a real one. But the trade-off is risk and position in line. Common stockholders might receive dividends, but those are never promised. In a hard year, the company can simply decide not to pay them, and there's nothing you can do about it. And if the company fails completely and gets wound down, common owners are dead last in line to get paid, after every lender, every supplier, and every other claim is settled first. Sometimes last in line means there's nothing left by the time they reach you. Highest potential reward, highest exposure, that's the deal. Preferred stock sits in a different place entirely. Preferred owners usually give up their vote. They trade away their say, but in exchange they get priority. Their dividends are paid first, before common shareholders see a single penny, and those dividends are typically set at a fixed amount, which makes them feel a lot like steady income. If the company is ever wound down, preferred holders stand ahead of common holders in the line to be repaid. It behaves like something halfway between a stock and a bond, steadier and more income-focused, but with far less of the explosive growth that makes common stock exciting. And here is where I have to stop and correct something you will hear repeated absolutely everywhere, because it's the kind of comfortable half-truth that quietly costs people real money. You will hear preferred dividends described as guaranteed. They are not. Not in the way that word makes you feel when you hear it. Yes, these preferred dividends are usually fixed, and yes, they get paid before common dividends. Both of those things are true, but they still depend on the company actually having the money and choosing to pay under the specific terms written into that particular issue of stock. A company in genuine trouble can suspend them. Some preferred shares let the company skip payments entirely under certain conditions. Priority is not the same word as guaranteed, and anyone who blurs those two words together is either careless or selling you something. This is where most people get it wrong. They hear guaranteed income. They relax completely, they stop reading the fine print, and they stop asking the very questions that would have protected them. Honest income? Yes. Guaranteed income? No. Hold that line. So which kind is better? Neither. And that's the honest answer the brochures won't give you. It depends entirely on what you actually need from the money. If you want maximum growth and you can genuinely stomach the swings and the risk, common stock is built for exactly that. If you want steadier, more predictable income and you're willing to give up both the explosive upside and the vote to get it, preferred leans that way. Two different tools for two different jobs, owned by two different kinds of people with two different goals. Not a smarter choice and a dumber one. Just a question of what job you're hiring the money to do. Now we arrive at the question that lives underneath all of this. The one a sensible adult who has worked hard for their money absolutely should ask. Why would I put my hard-earned savings into something that can fall when I could just leave it sitting safely in the bank where I can see it? It's the right question, and it deserves a real answer, not a sales pitch. The honest answer comes in two halves, the case for and the catch. I'm going to give you both fully, because you've earned the truth and you're old enough to handle a trade-off. The case for is growth and the cost of standing still. Money sitting in a typical bank savings account earns very little. Depending on the year, the country, and the kind of account, that can mean barely more than nothing. And here's the quiet part nobody at the bank mentions. While your money sits there earning almost nothing, inflation is steadily making each of those dollars buy less. The number in your account stays the same, but what it can purchase shrinks year after year. Safe money in the bank isn't actually standing still. It's slowly walking backward. That's the cost of doing nothing, and it's real even though you never see it on a statement. Meanwhile, broad baskets of stocks have, over long stretches of history, grown far faster than that. Now you'll hear a very specific range thrown around constantly online that stocks return 7 to 10% a year. I want to handle that number honestly because the careless way it usually gets tossed off is genuinely misleading, and believing it too literally will hurt you. Here's the careful version, the one that respects your intelligence. A broad index of large American companies, something like the S&P 500, which is really just a basket of 500 of the biggest businesses in the country bundled together, has produced long-run average returns in roughly that neighborhood over many decades. That much is real and well documented. But the word average is doing an enormous amount of quiet work in that sentence, and you need to see it working. That average hides the fact that some years are sharply, joyfully up, and other years are frighteningly, stomach-droppingly down. It changes depending on whether you count inflation, whether you include dividends, and exactly which window of history you happen to measure. 7 to 10% is a long-run average looking backward. It is not a promise. It is not a yearly paycheck you can count on. And it is absolutely not a guarantee of anything in the future. Anyone who hands you that number without that whole paragraph attached is doing you a quiet disservice, whether they mean to or not. Now the catch, said plainly, with no varnish on it, that long-term growth is the reward you are paid for tolerating short-term pain. The stock market is not a smooth, gentle climb. It is a roller coaster with a track that, over decades, has generally pointed upward, but with real drops along the way. There will be years when your slices fall 20 or even 30% on paper, when the news is grim and every instinct in your body screams at you to sell and make the fear stop. Here's what most people never understand. The growth and the volatility are not two separate things you can pry apart. They are the same single thing, seen from two different angles. You do not get the long-term upside without accepting the short-term lurches. They come as a package, and anyone who promises you the climb without the drops is lying. The bank is steady and quietly shrinking. The market is bumpy and has historically grown. That is the real trade, laid out honestly. And now you can actually choose with your eyes open. And this is where the difference between two completely different kinds of people shows up, and where a lot of folks get quietly steered wrong. Some people buy slices in order to own them, to hold pieces of good businesses for many years, collecting dividends and riding straight through the bad seasons because they understand what they hold and why. Others try to dart in and out, buying and selling on every little wiggle of the price, trying to outguess the crowd about what next week will bring. That second activity has a name: trading. And it is much closer to speculation than to genuine ownership. It is exhausting. The odds are stacked against the amateur, and it is not what we teach here. You don't need more money to get started. You need a better plan. And the plan, the one that's quietly built more ordinary wealth than any hot tip ever has, is built on owning, not guessing. So let's gather everything into something you can actually use, because understanding without a plan is just expensive trivia. Interesting at dinner, useless in your account. You now know the one true thing that everything else hangs from. A stock is a slice of a real business, and as an owner, you gain when the business grows, and you can be paid dividends along the way. You know why companies sell those slices in the first place: to raise money they never have to pay back like a loan. And you know that the day-to-day price on your screen is just investors trading slices among themselves, while the real company keeps working regardless. You know that price and value are two different things, and that the gap between them is precisely where both the fear and the opportunity live. You know there are two kinds of slices, common and preferred, with different trade-offs and no guaranteed anything, no matter what the brochure says. And you know the honest deal underneath it all: long-term growth in exchange for tolerating short-term storms, sold to you as a package you can't unbundle. If this is the kind of straight answer you've been looking for, no hype, no velvet rope, no jargon designed to make you feel small, just the truth told plainly to an intelligent adult, then do one small thing for me before we finish. Subscribe to the channel. That's the whole ask. Everything I make here is built to take the financial world that was deliberately designed to feel intimidating and hand it back to you in plain language you can act on. Subscribing is how you tell me to keep doing exactly that, and how the next piece finds you when it's ready. Now, the final piece of the blueprint, the part that turns all of this from understanding into actual growing wealth. And I'll warn you in advance, it's almost insultingly simple. The simplicity is the whole point, and it's also the reason the financial industry doesn't shout it from the rooftops. There's very little money to be made selling you something this plain. You do not have to pick the next Diane's bakery. You do not have to guess which single company will soar and which will stumble. In fact, betting everything on one company is one of the most common ways ordinary people get badly hurt. Because if that one slice fails, so does everything you put into it. Think back to Robert. If Robert had put every dollar he had into Diane's bakery, and only Diane's bakery, and that recession had sunk her, Robert would have lost everything. The professionals have a phrase for the alternative, and it's really just the old proverb your grandmother already knew: don't put all your eggs in one basket. Here's the quiet revolution that makes it possible for someone like you. You can now buy, in a single simple move, a tiny slice of hundreds of the largest businesses in the country all at once, through something called an index fund. Instead of owning one bakery and praying, you own a sliver of 500 different companies, so that no single failure can ever sink you. If one of those 500 goes under, you barely feel it. The other 499 carry you. It's low cost, it requires absolutely no genius stock-picking talent, and decades of hard evidence show it quietly outperforms most of the highly paid experts who charge you handsomely for the privilege of trying to beat it. Own broadly across the whole market. Add to it steadily, the same modest amount every single month, in good times and scary times alike, without trying to time anything. And then comes the genuinely hard part, the part that has nothing to do with intelligence and everything to do with temperament. Leave it alone. Let time and patience do the heavy lifting that no amount of cleverness ever could. That's the entire plan. It's not exciting. It will never go viral. It is the opposite of everything the fast-talking videos are selling you. But it is honest. It is built on owning real pieces of real businesses, and it has worked for ordinary, patient people for as long as the market has existed. There's a scene I want you to carry with you after this video ends. It's an ordinary Tuesday morning. A few years from now, you're standing in your kitchen with a cup of coffee, and the news is murmuring in the background. The market is down, sharply, the kind of red number crawling across the bottom of the screen that used to make your stomach drop and your hand reach for the phone. A younger, less informed version of you would have felt that old animal fear. The urge to do something, anything, to sell, to make the bad feeling stop before it got worse. But you just watched this video, so you know exactly what that red number actually is. It is not your bakery burning down. It is a crowd of nervous strangers for one frightened week, agreeing to pay a little less for slices of businesses that are still baking bread this morning, still shipping products, still opening their doors and serving customers exactly like they did yesterday and will again tomorrow. The price moved, the value didn't. And you own the value, not the mood. So you take a slow sip of your coffee and you do nothing at all. You set the cup down, you find your keys, and you go to work. You let the slices keep being slices of real companies, quietly compounding year after year, while the crowd panics and recovers and panics again, the way crowds always have and always will. That, right there, is the whole transformation. It was never a hot tip. It was never a secret stock or a special account only insiders can open. It is simply, completely, the difference between a person who looks at a screen and sees a frightening number and a person who looks at the very same screen and sees what they actually own. There are two futures available to you from this moment forward. In the first, all of this stays a thing that other people understand. Younger people, richer people, people on the other side of a velvet rope you were taught not to cross. And your money keeps sitting somewhere safe, shrinking quietly against inflation for another 10 or 20 years, while you tell yourself you'll figure it out someday. In the second future, you understood it today. You finally saw that it was always just a slice of something real, and you let that one understanding compound, slice by slice, month by month, year by patient year, into something solid enough to change the entire second half of your life. The only thing that ever stood between those two futures was the single idea you now carry in your head. So, 3 small things before you go. Subscribe, so the next piece of this finds you when it's ready. Share this video with 5 people you genuinely care about, because someone in your life is standing in front of that same velvet rope right now, feeling that same quiet embarrassment you felt at the start, and you have the power to take it down for them in under 10 minutes. And leave one comment. Tell me the one financial word you always quietly pretended to understand but never actually did. I will explain it next plainly, the same way we did today. You were never locked out. You were just never told the truth simply. Now you have been, and the door was always yours to open.